with valuation still well above historic norms. There's a lot of folks out there saying the market is just too rich. It's not a good time to be investing. We're joined now by Vitaly Katsenelson, who's portfolio manager at Investment Management Associates and author of Active Value Investing. And you are a value guy, and as we talked in another segment, you said the market is expensive and you're concerned we're going to be still at 10,000 another 10 years from now. But there are opportunities in there, and you like Pfizer, which is a name that's gone nowhere for a long time. What's the bull case for Pfizer?
I have a watch list of stocks on my computer, which is a couple hundred stocks. And one sector that jumps at me has been cheap overall is pharmaceuticals. So what I'm saying about Pfizer is true for a lot of pharmaceutical companies. So you look at Pfizer, it's about under $20. It's been at 50 or 60 a decade ago. So stock declined. Right now it's facing a huge expiration of Lipitor, which is about $12 billion of sales. That's, so everybody knows why Pfizer is a horrible stock to own. Hasn't gone anywhere, actually declined a lot. Huge expirations, etc.
Nothing in the pipeline is to get really excited about. Or that's the consensus.
That's right. So their results from pipeline last 10 years were not that exciting. Okay, but here's the thing. So if you look at Pfizer, if you value Pfizer right now, it's basically discount as the drugs that will expire, and the revenues will decline from those drugs, and they will not come out with a single new drug ever again. Okay, so in other words, Pfizer spends about $11 billion a year on R&D. That money is wasted. So that's what is discounted into the stock. The thing is, they actually have over 100 drugs in the pipeline, 25 or 30 of them actually in the stage 3 trials. So those drugs are much closer to be on the market. I don't know when these drugs will come out. But maybe there's another way to look at Pfizer. It's basically like a bond with an embedded call option that is free, that is paying you 4% a year. So it's almost like a perfect stock for this economy in the sense that if economy just keeps growing at very slow rates, this company actually still has a pricing power. It can raise prices over time. If you have inflation, it can raise prices. If it has deflation, it can maintain prices. So from that perspective, it's a very very good stock. Also, what created a lot of value, and I never thought I would say that, it's the acquisition. When Pfizer bought Wyeth, they didn't do the typical thing. They didn't pay 20 times earnings for the company. They bought it at the time, basically in the midst of the crisis. So therefore, they paid only 13 times earnings. If you look at the synergies, the cost savings, etc., they actually paid closer to 10 times, earnings. That's incredibly cheap, and I think that's actually created a lot of value for the shareholders.
So, looking at pharmaceuticals in general, why are these stocks such dogs? I mean, you've got healthcare, doesn't matter. Global depression, still up 5% a year in spending. Obviously, we're all getting older. We need more and more drugs. There's all this huge R&D. It's one area where the U.S. still has a real competitive advantage. Why are these stocks such dogs?
That's a good question. If you look at the 90s, these companies grew earnings 10, 12% a year like a clock. So they got to valuations which basically didn't justify even that growth rate. They got to 30 times earnings. From that point on, they didn't even deliver the growth. Actually, a lot of them the earnings declined because they had expirations. So you have you had very high valuations, disappointment of growth, and therefore the P's contracted tremendously. Okay, so now you got to everybody who owned them already sick of them. And that's why you have this negatives, kind of negativism towards the stocks, and that's what creates the opportunity.
So what about the idea, I know you're a value guy, but a lot of other people say, the biotech sector is where you want to invest in because you have the opportunity for much greater earnings potential and the possibility that the Pfizers of the world will buy them out.
That's very true. I just don't know how to analyze biotech stocks. I don't know how to value the pipeline, so that's...
Right. Okay.
As a value investor, you ask yourself a question, what's the margin of safety? And when you can't value something, you can't really assign a margin of safety to it. So,
Okay. So you do own Pfizer, yes?
Yes,
okay.
Yes, we do.
Any other big pharma stocks that you own?
We own Glaxo, which has it's a very similar story to Pfizer, and we own J&J.
Right. And before we wrap outside of pharma, you were mentioning before we came on, Vodafone is another name you like here?
Yeah, Vodafone is a very interesting company because they own 45% of Verizon Wireless. And Verizon Wireless has not been paying out cash flows to Vodafone for a couple of years. So investors basically put in zero value on Verizon Wireless. Verizon Wireless, which is owned by Verizon, at some point, last year or 2 years ago, they bought Altel, and they had to borrow $20-30 billion. They've been paying it down. And that generated an enormous amount of cash flows. So at some point, they're going to have to start paying out these cash flows to the parent company, Verizon. And if they do that, 45% of that has to go to the Vodafone parent company. So if you take out the value of Verizon out of Vodafone, you're basically paying about 6 or 7 times free cash flows. And you're getting, 6+% dividend yield. Again, it's it's almost like a Pfizer profile in a sense. It's like a bond with a very nice call option.
All right, Vitaly, thanks very much.
My pleasure.